Hello and welcome to the Cash Furnace. My name is Paul Kinzerski, and together with my co-host Eric Downs, we aim to become your go-to source for daily stock and crypto market news. Today's date is February 25th, 2021. Today, we're going to cover in the regular markets, the stock market crash. Also, Eric is going to give us some education on what a 10-year note is and why it relates to today's crash. In crypto news, we're going to go over Coinbase's public filing for IPO. We now can see into their financials a little bit of the details, and we're also going to cover what the whales are doing. Again, snapping up all of your crypto. Thank you for tuning in. If you like what you see and you want the news to keep coming, you know what to do. Like, comment, subscribe, share this with a friend who wants to make more money and help us make more people more money. Let's run up that YouTube algorithm. And without further ado, let's get into the episode. Today started off well in the regular stock market, Eric, but then
it did
straight down.
And then it took a massive dump. My God. So why did that happen? All right, everyone wants to know. Everyone's asking. Here's a big one. Here's probably the biggest reason that happened. The short answer is that the 10-year Treasury note has been spiking like borderline parabolic in value. And today it actually crossed over the 10-year Treasury note yield actually crossed over the S&P 500 yield, which is a major event. So here's what that means. We have to start with what is the 10-year Treasury note. So 10-year Treasury note is basically it's the lifeblood of the government. It's basically the way that the government funds itself. And so it's a bond that you pay for. You give the government your money. Give the government your money, and they're going to pay you back interest on your loan every 6 months, and then in 10 years you get it all back, right? So it's generally seen as the bare bones minimum, like the lowest interest rates. It's the core foundational loan that gets capitalism running, and it's generally seen as basically the safest investment you can ever make. Now when COVID hit, before COVID hit, we were sitting, the 10-year yield was roughly in the, close to roughly 2%, right? And you might have noticed this in for instance, the interest rates of high yield savings accounts is about the same. When COVID hit, everything went straight in the shitter. Including these yields, which I think I don't know if I have them in front of me, but they went down to like near zero. Now here's why that's important. When investors look for security, not necessarily high growth, high return, but when they're looking for stability and security, this is the core pillar on which all of our financial system is largely built. Our government. So they would go to that, but when it's no longer returning basically anything, when it can't even keep up with inflation, then it doesn't make financial sense to even invest in it at all. So this drove investors largely to other places where they could find yield. Well, because pillar of like so many of our interest rates and stuff, bond prices are killed. Interest rates are basically no yield interest rates anymore. So what do we have left? We have the stock market, and that's what we saw. And that's it's plain economic science that everybody looking for returns said, well, we got stocks, let's jump in there. And it just so happened that there were a lot of stocks that were killing it in 2020, as we know. Well, here's the thing. That 10-year Treasury note yield has started to arc up pretty dramatically, very quickly as of late. And the thing is when that spikes, it then becomes Well, when it spikes and it crosses over the yield of the S&P, it then becomes a viable investment vehicle.
Right. Because
again,
it's a
right? And in
guaranteed
this case, if it crosses over
it's a
the
guaranteed return over the S&P 500.
exactly,
Right.
that's exactly right, and it's much more. It's more stable. Again, it's not huge. It's not huge returns, but it's
Right.
stable. And a lot of investors want stable. A lot of this country wants stable. So when these Treasury notes become more appealing than the S&P 500, what do you think we're going to see? We're going to see rotation out
Yep.
of the general equities market and into the Treasury yield. It spiked like crazy today, dude. It spiked like a penny stock today, and as we saw, it took the S&P down with it.
Big time.
Here's the thing. Yeah, really big time. So the question now that I think is surely looming in everyone's head is like, what's next, dude? Is the yield on this thing just going to keep rocketing up? And if so, is it going to take the S&P down with it? And the big question is, why is it going up? Now, I'm going to be perfectly honest with you. I don't think I'm enough of an expert to authoritatively say to explain this. But from what I understand, it's basically investors hedging against major inflation worries.
I was just going to say that.
Yeah.
That's what I'm of the same opinion, right? I don't think, I'd say 9 out of every 10 people are expecting, once we get back to a recovery, once we get back to a normal economy again, for inflation to absolutely run. Because the Fed has been printing so much money, but that money hasn't been going into circulation. Savings rates are actually higher than ever, right? People are paying down debt with this money that's getting printed. So we haven't seen the multiple returns that you normally would get out of this money. So for our viewers, I want to kind of put it in perspective, right? And I think we've touched on this before, but again, to reiterate, generally, when the economy is going good and you receive a $600 bonus out of nowhere, right? Typically, the American public does not stick that in a savings account. Typically, what they do is go on a shopping spree, right? So say, all right, I have this extra $600. I'm going to take my fiance out to a really nice dinner tonight. I'm going to go, we're going to have a couple of nice bottles of wine. Check comes $250, doesn't matter. That's not even half of what I got. Now that $250 goes towards the restaurant, goes towards that waiter and the tip, goes towards paying the chefs, goes towards paying the waiter, goes towards the landlords who own the building that the restaurant is using. Those employees then take that money that they received partially from that payout. They pay their rent, or maybe they go buy something, or maybe they go to a restaurant. And it's this exponential, basically, that the Fed wants to happen, essentially, to re-stimulate this economy. The problem is, because of COVID, because everybody's been stuck inside, spending has gone down quite a bit. And so we haven't seen this. And again, savings rates have jacked up. So now what a lot of experts are thinking is that all of this saved money, all of this pent up energy to go travel, to go spend, to go to resorts, to go out to eat, all of it is going to suddenly kick into the market really fast. Restaurants are going to be overloaded. Resorts are going to be overloaded. Airlines are going to be overloaded. And the result of this is prices are going to go up really quickly, and inflation is going to happen at a lot higher rate than anybody really expected because of the trillions and trillions and trillions of dollars now that have been printed in the US economy that we're going to see this very delayed reaction to. So I believe the general estimates are over the next 2 to 5 years, us seeing right around 8 to 10% inflation on the US dollar, which is a lot higher. And
it's just insane.
Yes. And what's going to happen if that does occur means lending is going to be more expensive. Loans are going to be much harder to get. Housing prices might go down. Your food, your daily cost of living is going to go up. There are a lot of negative things that can potentially come of this. And this is a first kind of warning sign. This is a warning indicator that this is actually going to happen.
Right. And it basically it's spooked a lot of people, as we always say, like, the market buys confidence, it sells uncertainty.
Yep.
And today was a giant uncertainty signal.
Agreed.
Was a giant warning flare that went up in the sky, and everyone's like, okay, maybe the party's over now. Now, Paul, you correct me if I'm wrong. Now, for our viewers who wish to best position themselves, how do I say, against this potential inflationary environment we're going to see. Correct me if I'm wrong. If my understanding is correct, the winners in an inflationary environment are asset holders.
That's absolutely
correct.
Is
that correct?
So, again, this is one of my favorite stories. Over in England, they call him the inflation king. And I believe, again, I've said this on the podcast, but long story short, there was a man in England who identified that massive inflation was going to happen. Now, granted, it was a lot higher than 8 to 10%. I believe it was like 35 to 40% inflation. But
oh my God.
But what he did at the time, this was, I want to say like 70 or 80 years ago. What he did at the time was he snapped up everything. He took a loan on anything he could get his hands on. All utilities, all commodities, everything that he knew was going to hold its relative value. He took out massive loans on and just bought a shitload of businesses. And what that did, because he had a very low APR on all of his loans, and this massive inflation was going on, all his assets, their total value, rose to incredible heights. And those original loans that he had were pennies, were mere drops in the bucket compared to the overall value of those assets that he owned. And this is a very similar thing here. It's something that I've been looking at a lot over the past year. And I wish I was in an area where in my own personal life I could have taken more advantage to it, because I think that's going to happen to a smaller degree here. I think if you bought a house this summer before housing really shot off, I think if you got a 0% to 2% loan on a car you just bought, all of these things, if you started a business and you got a really small 2.5% loan on your business, you are going to make out from this. And it's just taking advantage of this situation.
Yep.
Not to mention,
I agree.
Our specialty of stocks and crypto. All assets are going to rise, including those as well.
Those are all assets.
Yes. The dollar value of each of those is going to go up significantly compared to any debt you might have pulled out. But go ahead, Eric. I cut you off.
Exactly. Yeah. So, I mean, no, you didn't. You said exactly what I was hoping you'd say. And this is I think the benefit here is that this is plain language advice. We're not financial advisors. This is not financial advice, but this is an explanation of basically how you can prepare. Very simple language. Look for assets that says you can, because they're going to go up in value, Yep. And that's all there is to it, really. So, if you have real estate, amazing. If you have equities, amazing. If you have crypto, amazing. Anything in that world, anything that has the ability to appreciate in value just by existing, that's what you want.
And if you
want to get that stuff, do you need to
if you have hordes of cash sitting around, that's the one thing you don't want, because that money is going to depreciate. We've said it a million times. Cash is a losing bet right now. Granted, yes, banks interest rates that they pay you for savings will go up, but it won't be nearly as much as if you owned an asset instead. Yeah.
Nope. And you won't know it. And you won't know it because it's not something you're going to see on a daily basis.
Right.
You know, it's not like a stock that goes up or down. You're not going to notice your money wasting away. In fact, you can't, because because when you check in at the bank, you're still going to see the same dollar amount. It's not like you're going to have less dollars in there. It's just that everything else, its
Yes.
buying power goes down. Everything else is going to get expensive around it while you keep the same amount of dollars.
The number stays the same, but it's worth less, right? Till eventually it becomes worthless, and which is crazy to think about.
Right. But that's exactly it. That's how we always say this. Like, cash is a wasting asset. You know, it's just like a car, man. Every day that goes by that you own a car, it's worth a little bit less. You know, it's anything along those lines. Any wasting asset, any depreciating asset. And cash is one of them, man. So yeah, plain language advice. So anyway.
Yeah, I think that's a good recap on the general market. So I want to switch over to crypto here, because we finally got a little insight into Coinbase's financials, right? And it is astonishing to me what one exchange now is now holding. We're talking, so before they released their financials, Bitcoin's general projection for public valuation was based off of the numbers people had a general idea of for the trading volume. And that was at $77 billion. It is currently, as of their financial release statement today, $100 billion valued IPO. $100 billion. Started by a couple college kids who said, hey, we can make one of these exchanges. Why not? They now own over $90 billion of assets on their platform. $90 billion. That is insane amounts of, like, you can't, as a human being, wrap your mind around how much money that is. It's absurd. And this has been it is since I think they were established in 2014 or 2015. So Coinbase has gained that many assets in that little time.
That's got to be some sort of record?
I have no idea.
Right? That has to be some sort of record.
But it's mind-boggling. Oh no, 2012 they were established. But still, that is
9
exchange.
years.
Granted, it's a very large exchange. It's one of the easiest to get into. They've made it so simple to buy into crypto, to dollar cost average into crypto. It does it automatically for you. It's why people like them. But this company that has this much assets on their portfolio still, when it comes to high trading volumes, crashes every time. When there's a major drop or spike in the price, you cannot make a trade because the app crashes. The app crashes, the desktop crashes, everything crashes. It's ridiculous. You can literally predict it to a T.
Unreal.
And even with all these assets on their balance sheet, they're predicting they're going to lose money for the foreseeable future because of simply how much volume is going on and all the problems they're dealing with when it comes to these surges on their servers and everything.
My God. Wow.
Yeah.
Okay.
I know.
That's unbelievable.
It's wild to even see.
So, Paulie, when Coinbase IPOs, are you buying Coinbase when it IPOs?
100%. I'm already so crypto heavy too, but it's an opportunity that you cannot miss, man. I mean, look at the growth.
I agree.
It's been 9 years, and they have 90 billion of people's dollars on their platform.
It's pretty insane.
10 billion a year average gained. That's fucking mind-boggling.
Sounds like a great
no,
investment, Paulie.
I completely agree. I only think it's going to continue to rise, especially if they freaking work out these server issues, man. Because it's actually a laughable joke. Like it is in the crypto community, it is a joke. It's quite literally like, oh, we
Really?
saw a volume spike. Bitcoin and or Coinbase and Coinbase Pro is going to be down. Sure enough, you check the app, they're down. It's like it is predictable to a T. Ridiculous. Anyway, getting off that, I just wanted to go into what we reiterated. We saw the wallet inflows and outflows, right? We saw they were going to major whales. And what do we get today? MicroStrategy, Michael Saylor's firm, the first firm to really, really buy into this crypto run and who have bought billions and billions now in crypto assets. They bought $1 billion worth of Bitcoin on this last drop with a B. At $46,000 on average, they bought $1 billion worth of Bitcoin. Again, I say it every day. This isn't going anywhere. We're only going up.
Dude,
we have at least 6 months of this. 6 to 8 months. Even if I'm wrong and the market does correct, we still have 6 to 8 months of a bull run to go.
My God. I guess I got to buy some more crypto, huh?
If we do, so I was looking at the chart today, and we're at the peak of two major resistance points. One of them being the very latest ascending triangle that we had, or ascending pennant, not ascending triangle. And another one being the resistance line that was drawn through the past couple of bull runs when we were running a little lower at like 33 to 36K. And today we are testing the exact intersection of both of those, like at this moment, right? So we could have a really hard push down from it because these are two major resistance levels. If we do see a hard push down, I could see us breaking through the 46 and again hitting that 42. But there is so much institutional money at 42 that I see us. We talk about that trampoline yesterday where we saw the S&P 500 dive down, just touch and spring up. If we hit that, if we hit that 42, we are going to absolutely skyrocket. Fuck a trampoline. It's like a launch pad is sitting right there. And I'm just waiting for it to hit my fucking my buy area and just skyrocket to new all-time highs. So that's my prediction.
My God.
If we do go down, that's where I'm thinking.
Inspired me. I'm gonna set a buy at 42.
I put it a little bit higher. Put it at 43, just to make sure it fills.
I'll put it 42. 42.01.
Okay.
Come on, man.
Watch it go down to like 42.03. You miss the fill, and then it launches. Because that's a trader's luck, right?
Hey, you know what? If it launches, I'm happy too.
This is true.
That's a trader's luck. But you know what? If it launches, I'll be perfectly happy. So either way, brilliant.
Hey, you know why you'll be happy? Because you took your cash and you bought
assets. It's simple. It's simple, folks. You can look this up. You can Google it. What separates the haves from the have-nots? It's assets. You look at the net worth breakdown of high net worth individuals. It's assets. It's always assets. It's not cash.
Everyone,
there's not king.
Everyone with fuck you money has fuck you money because their money, their assets, they bought assets that paid them every single year, every single day. And they can do whatever they want because of that. They don't have that cash just slowly burning away in a bank account. But with that, not to sound too preachy, thank you for watching today. If you like what you saw, you know what to do. Like, comment, subscribe, hit that notification bell so you know when we go live with these updates and help us make more people more money. With that, we'll see you tomorrow.
That's right.
Cash Furnace out.